Hey everyone, welcome back to another episode of the Everyday Trader. This is Greg Jensen, CEO of Options Animal. Good to be with you again today. I'm joined by my friend and co-host, Eric Hale. Glad you're here, Eric.
Good to be here, Greg.
And last episode, we kind of left off with a little bit of a teaser of talking about a trade right now. And so I think I want to jump right into it with a little bit of a preface. And that is kind of setting the expectation for those of you who, I know some of you are Options Animal students who follow us, some of you are not. For those of you who are new to Options Animal, don't understand 100% of what we do at Options Animal, why we're different. One of the ways that we approach the market that's different is taking a different perspective of risk management. And a lot of traders out there in the world trade with things like stop losses as their means of risk management. They trade with maybe only certain types of portfolio mixes. Maybe they control risk by putting it all in, mutual funds type of risk control. And we're a little bit different in how we view risk. We are active traders in that we use instruments, use tools to change the position of how we trade based on what the trend of the market is. I may set out and say I'm bullish on a stock like Tesla, and then something happens with Tesla and it goes bearish instead. A lot of traders will just cut their trade, limit their losses and move on to the next trade. And what we do is we teach people how to, instead of walking away from opportunities, because inevitably, I'm sure many of you who have traded have said that example is I was bullish on Tesla. All of a sudden, one piece of bad news may come out about the stock, causes it to go down a little bit. You panic out or hit your stop loss, only to then watch the stock turn around and go back on a bullish tear back to the upside. And you miss on that opportunity. And one of the things we try to do is, instead of using stop losses to control risk, is we adjust. And that really is the basis behind this trade that we're going to talk to you about today. Not that we're going to go into the details of the adjustments. I know you Options Animal students have paid thousands of dollars for that knowledge, and we're going to keep that behind Options Animal. But what we wanted to share with today is this concept of how to approach the market with a different mindset, and specifically with this trade that Eric has coined. And I'm not going to take the thunder away from your name for this trade. I'll turn the time over to you first for that. But I just wanted to set kind of the expectation of this is how we think differently about the market. And from my perspective, it completely changes my stress level in the market. I don't stress about the markets. And that's been a beautiful thing for me for the last 20 years as I've done this. The market does what the market does, and if I'm flexible enough to roll with the punches, then I can make money in the long term. So that's enough of an intro. Eric, jump us into this trade idea that we've been talking about and how it works.
Okay, great. So before we do that, very timely today, I saw something come across my desk from Jason Zweig. Jason Zweig writes for the Wall Street Journal. He's actually been gone for 6 months because he's working on a book. But his newsletter today was talking about historical bias. And Greg, if you remember where we were 12 months ago, so absolutely everybody was certain of a recession and a hard landing and bearish on the markets. Everybody needed to buy bonds and sell stocks. And we are a mirror image of that 12 months later. And what's ironic is all these people I was actually bullish last year. So his point is that we have a tendency to sort of change our minds. And I think this is the sort of stuff that keeps us from being depressed and being able to function, is that we really don't realize how bad we are. But it's important because actually, and I'm not joking about that actually, because these heuristics that we have, this behavior, these biases that we have, help us to function, and they exist Like, for example, when something's strange or out of a place, there's a natural sense to avoid something. We're risk adverse. We tend to see our losses bigger than our gains, and these heuristics play out in the market not as something that helps us out. We tend to be very overconfident, and the truth is we're not really that good. So you want to try and eliminate as many biases, and this occurs in a lot of different places too, not just in the market, where some of us don't have open minds, and aren't open to other ideas that are out there. And I think, trying to be objective. Muhammad El Arian talks about, he said a concept one time that has really resonated with me, and that is that I believe in something that is wrong, and I don't know what that is. And I should seek to try and change my mind, because that's a good idea. So what happens a lot of times is we get in our head that, hey, we're bullish on Tesla and we're going to stick bullish on Tesla. And I'm a big Elon Musk fan, but I will trade Tesla bearish if I have to, because it's not about that. It's about making money. So if I want to support Musk, I'll buy his products. But if I am going to try and invest my hard-earned retirement, I need to make money. So there's a strategy that I've used for a long time that has really, over the past 4 or 5 years, that I've started using this strategy more often than not, and it works very well. Let me explain and go through some slides. So I we're probably going to go a little longer than normal here. Hopefully, we can keep this under another half an hour or so. We can get through these. We'll see. But this is my favorite trade. I call it the Costanza trade, named after, yes, George Costanza from Seinfeld. So let's walk through, set the stage and walk through this. Before we get through this, I am going to read this disclaimer that this is both applies to Options Animal and Trader Oasis. So this presentation shouldn't be considered any sort of recommendation to buy or sell anything. All information is for educational and illustrated purposes. Trader Oasis is not in the business of transacting security trades and doesn't direct client accounts or offer trading advice. Trader Oasis is not a licensed financial advisor, registered investment advisor, or registered broker dealer. Options do involve risk. They're not suitable for everybody. All rights and obligations need to be fully understood. So you should all know this. This is important. But all right, so here's our agenda on the Costanza trade. So we're going to talk about the most important thing. And this is actually something that applies to everything, not just this trade, but all option trades. And then we're going to face the reality is that you suck at picking stocks. And let's hope that the odds are in your favor. Little hat tip to Katniss Everdeen in the Hunger Games. Yes, there. Always do your due diligence. We're going to look for bullish stocks, and then be like George. So we'll talk about what I mean by that, and hope for the best, but plan for the worst. And then, of course, make your bet every day. There's some things you just have to do. All right, so the most important thing is liquidity. Excellent option liquidity is absolutely essential in order for you to make money. It does not matter what kind of options you trade, you have to have good liquidity. Right, Greg?
Well, this is really apparent in volatile markets is where it becomes really, really important. You may look at it and say, oh, well, I know I'm trading this little no-name, Russell 2000 stock, and I'm not a big player. I'm only doing 1 or 2 contracts, so I can get in and out really easy. And that spread doesn't make that big a difference for me. But when you're in a really panicked scenario, if the market's got a lot of vol in it, you want to be able to get out of trades that you're in. And that is only going to happen if you've got good liquidity.
And liquidity, what we mean is how much you overpay when you buy something and how underpaid you get when you sell things. And there's a good measure. Some people will look at volume and open interest, but the best method for you is to use this little test. So look at the first call that's around 30 days from today and out of the money, and take the difference between the bid and the ask and divide it by the bid. And you want to see that around 2%. Anything less than 5% is good. 2% is as great as it can get. If it's 10% or more, it's barely tradable. And if it's over, if it's over 10%, you don't want to trade it. So somewhere between that 5 and 10% is kind of a gray range. But take a look at, for example, imagine you're going to do a covered call and the stock goes in the money and you want to close the trade early. The short call goes in the money. You want to close the trade early. If you look at the bid ask spread, sometimes it's as big as $5, and that is probably more than your profit. So this liquidity test, you can think of these percentages as taxes. And so when you start seeing 10% tax, 20, 30, 40%, listen, I hate taxes. So taxation is theft in my book. I'm a card carrying libertarian. So I hate overpaying. And if you don't need to pay, this means you may have to walk away from certain equities. This means you can't trade your not well-known company that's somebody you really love, that's a Russell 2000 stock, as Greg used as an example. That's fine. You can't trade them. So if you want to buy the stock, but you're not, if your goal is your goal making money, or is your goal to trade a particular company? So get that straight. And if your goal is making money, you're going to have to walk away from a lot of equities because they just have poor liquidity. So don't pass go. If it has poor liquidity, it's don't pass go. So this is the first test that's important. Next, let's be honest. How good are you at picking stocks?
I'm horrible.
You're horrible. You suck. You and I both get this question. Are you bullish or bear? Are you bullish on Tesla, Eric? What do you think? You know what I tell people? You should do the opposite of whatever I say, because I'm probably wrong. Most professionals can't beat the flip of a coin. And you can't either most of the time. I want to share some data that has been around for a while. There was a study that CXO Advisory Group did, grading gurus, and they took 6,600 data points over a period of time and studied these names that are on here. There's people on here that you recognize: Jim Cramer, Bill Gross, John Malden, Elliott Wave fans. So the accuracy here, these two guys are as good as the flip of a coin. Everybody else on here isn't. The average accuracy, which includes the best of the best, is 68%. The best of the best is 68%, which is just amazing to me that you're only right 68% of the time. But most people, the average is 48% in terms of their accuracy. It's worse than the flip of a coin. And there's all kinds of interesting reasons for that. But literally, the thing that's amazing to me is that only 33% of the people on this list can beat the flip of a coin. So 67% of the people on this list are no better than the flip of a coin. Now, this should be sort of sobering to all of you, because it's the reality. Most of you are wrong. So embrace it. What do you do about it? Well, I'll tell you one thing you can do about it, and that is to put the odds ever in your favor. Katniss Everdeen, Hunger Games, anyone? So I'm not going to dive into probability, because we could probably spend 45 minutes or an hour or a week talking about probabilities. But this is a graph that shows the movements of Apple for 52 years since it was publicly traded in 1980. And you notice there's something there that's a bell curve. And there are some things that you need to understand about the limitations of this probability, but there's a pretty good guess that these probabilities are going to play out in the future. So we can use models that use probability and put probabilities on our side. And it is completely valid to criticize volatility and probability models. Well deserved, because there are some serious issues with models. George Box is a famous statistician, and he's known for saying all models are wrong, but some models are useful. And sort of the implication is you need to understand where the limits are. And where the limits are is when you get way out on the tails, and we tend to make too many assumptions out there. But the theory here on this model works. It works for casinos, and it works for insurance companies. the odds are in your favor, and you can be the same as an insurance company when you trade options. Any comments on that before I go to the next one, Greg?
Well, I love the last comment you made, and that is that insurance companies have done a lot of math, and they know how to make money based on probabilities. And that's really what the basis of this trade is. It's really just using those same probabilities, recognizing that if you plan for the unexpected, there's still a way out. And that's what insurance companies do.
Absolutely. And insurance companies do not take uninsured risk.
Right.
And that's what reinsurance is. So they insure their own risk, which we can take the same concepts and apply. It applies to spread trading. That's what we're doing. We spread trade. That's why we don't sell naked calls and naked puts. There's better strategies for you.
Exactly.
And I will throw out that you always need to do your due diligence. So Options Animal, they teach you, I have my grandfather's milking stool here. This is a 3-legged stool. And I use this as an example when I go through this is very basic stuff. This is level 1 stuff that Options Animal teaches you, is that you have to look at fundamentals, technicals, and sentimental. And if your trade doesn't have all 3, your trade won't stand. There's no shortcut to that. And we could, again, spend a week talking about each one of these. So this is understood that you have some insight into the value of the company, that you are looking at the technicals with hopefully bullish setups, and looking at sentimental analysis, which is probably the most underused, underappreciated edge that each of you have, is to understand this. And we're not going to go through those here, but getting all 3 of these lined up and having a bullish sentiment based on these is important. But you're still probably wrong. So that takes me to Seinfeld season 5, episode 22. One of my favorite Seinfeld episodes. And I'm going to play a snippet if you don't mind. It's going to take 2.5 minutes here. So if you want to fast forward. But this is Greg and I are going to sit back and laugh here as we share this. Make sure you can hear this, right?
Every decision I've ever made in my entire life has been wrong. My life is the complete opposite of everything I want it to be. Every instinct I have in every aspect of life, be it something to wear, something to eat, it's all been wrong. Everyone.
Tuna on toast, coleslaw, cup of coffee.
Yeah. No, wait a minute. I always have tuna on toast. Nothing's ever worked out for me with tuna on toast. I want the complete opposite of tuna on toast. Chicken salad on rye, untoasted, with a side of potato salad and a cup of tea.
Well, there's no telling what can happen from this.
Chicken salad's not the opposite of tuna. Salmon's the opposite of tuna, because salmon swim against the current and the tuna swim with it.
Good for the tuna.
George, that woman just looked at you.
So what? What am I supposed to do?
Go talk to her.
Elaine, bald men with no jobs and no money who live with their parents don't approach strange women.
Well, here's your chance to try the opposite. Instead of tuna salad and being intimidated by women, chicken salad and going right up to them.
Yeah, I should do the opposite. I should.
If every instinct you have is wrong, then the opposite would have to be right.
Yes. I will do the opposite. I used to sit here and do nothing and regret it for the rest of the day. So now I will do the opposite, and I will do something. Excuse me, I couldn't help but notice that you were looking in my direction.
Oh, yes, I was. You just ordered the same exact lunch as me.
My name is George. I'm unemployed and I live with my parents.
I'm Victoria. Hi.
All right. That gets me every time.
My name is George. I'm unemployed and I live with my parents.
And you know, the rest of the story, as we know, it plays out well for him. He ends up hitting it off. And of course, like George, like every other episode, he screws it up at the end. But the point I'm making here is that you really sometimes just go with the opposite of what you think. I'm only joking a little bit, but let me tell you about this trade. So if you're bullish, let's place a bearish trade. So which bearish trade do you place? Taking everything that we talked about into consideration. First, that a lot of times you're wrong. No matter how confident you are, you're probably wrong in your sentiment. And if we think about the notion of the volatility and probabilities, we can use those to our advantage and put probability on our side. So the structure of this trade that I call the Costanza trade is a bear call, or some people know it as the vertical call credit spread. So this involves selling a call out of the money about 30 days till expiration. Generally, I don't think you want to go much longer. Going shorter could work, a couple weeks maybe, but generally I think 2 to 4 weeks works well. Selling a call slightly out of the money, and then a long call, generally 2 strikes out of the money. You could go 1 strike, but maybe 2 strikes is what I'm usually looking for, because it gives me some more flexibility and possible adjustments in the future here. So looking at how much return to risk you have here, I like to set up a ratio about 1 to 2. So if I'm risking 100, I'm making 200, or risking 100, making 400, depending on those ratios, somewhere in there, 1 to 2, 1 to 3, 1 to 4. I don't want to go much higher than that, because if the trade does go against us, it's a lot harder to adjust these. So focusing on narrow, if I need to, maybe I won't do 2 strikes, I'll do 1 strike. But these are the ideal sort of setups. It's important to know where your break even is, and that is going to be the short call strike, whatever that strike is, plus the credit of the spread. This is a very critical point to understand where break even is. And when I structure these, I want to see a probability somewhere around 65% of the trade working. So the stock can go up, and as long as it doesn't go above that break even, in theory, I should be able to make at least break even. So ideally, I want to see this at 65. I don't want it to be too much higher than that. And what happens when you get the probability too high is you start getting to much bigger risk relative to your profit. And again, those trades are hard to adjust if they go against you.
So Eric, and maybe this is a little premature to ask this question, but I'm going to throw it out there. And if you want to, kick it down the road, just kick it down the road to answer it. But okay, you're bullish, you're doing a credit spread. Why bear call? Why not do the put credit spread that, a bull put that's supposed to work in a
that is the notion
trend.
And people who think, second level thinking is, hey, I'm going to do a bull put, that put credit spread. I'm going to sell a put out of the money. I'm glad you brought this up, Greg, because this is an important concept. A lot of people do this. Hey, I'm bullish. I'm going to do a bull put. I'll sell a put out of the money so it's below where the stock is trading, and then I'll buy a put for protection later. Or maybe some people even do a naked put. And their thinking is, if the stock drops, I'm only going to buy the stock at a lower price than I would buy it today. And that makes a lot of sense until you've done it 1,000 times. I've done thousands of those trades, and every single time you feel the same way. And that is not good.
Yep.
Today, you say, hey, Apple's trading, let's pretend stock's trading at 100. And if I sell a put at 95, I'm going to buy it around 95 or 94, 93, depending on what my cost basis is. I'm good with that. But then the stock is at 90 or 85 or 80, and you don't feel as good then. Am I right?
Yep. No, it's absolutely
Are you the
right.
same way? Don't you feel that way? Yeah.
And obviously I knew the answer, what you were going to say to that question, because I'm the same
Right.
way.
I know you knew
I wanted to throw it out there.
You teed that up for me.
So that we could discuss this point, because you're absolutely right. When you're making an adjustment to a bull put by buying the stock and turning it into a collar trade, which to me is the core of where I trade. And I know that's where your discussion is going with this too. It sometimes is painful to buy the stock that's dropped from 100 down to 93. And yeah, maybe your cost basis is still 93 because you did this bull put at 95, and you're making this adjustment, but stock's at 93 and it's dropped 7% in the last 2 weeks.
Right.
It's painful. You
It's
really
painful.
have
And you
to
don't,
be like,
I guarantee you're going to be, I'm buying this stock, but man, I don't know that this trend's done, and it may be done. I mean, maybe you think there's a strong level of support or resistance, and I think there's some great times to do a bull put, because maybe you do think that it's, it's going to find that level of support or resistance, and who knows? But man, and this is, and then I find myself in a trade that I'm, you said the collar trade, which is a great trade, and it's, if you understand how to manage the collar trade, you really can control your risk. And it's just a matter of time before you can make your profit back. You can even make money with the stock going down. But you might be in this trade that's now in a bearish trend for 3 or 4 or 6 or 9 or 10 months or longer. And I've had a few of those go 10 months, go a year, but been able to get the profit out. But yeah, so I've gone away from doing, this is one of the things when I teach a class, we teach a class that does a review of all the trades, and we rank them bullish to bearish. And I throw that out the window. I don't, so you're very bullish, let's place a bullish trade. No, when I'm very bullish, I place a bearish trade. And so the point here that Greg was getting at is, and we're stealing a little bit of the thunder, the adjustment to this is buying the stock when it goes up. And that's when you feel good, because what happens with this trade? We'll talk about that in a second, but I wanted to mention, I say make your bed every day. I heard a speech from a general who said this, that you make your bed every day. So at least that night you've got a made bed to go into, but we should all be doing certain chores, and nobody balances a checkbook anymore. But there are certain tasks, if you want to trade like with success, you'll take some tools from project management. I like to use as an example. And I think each of you should treat your trades as a project. You have a goal, you have a schedule, you have a budget, you have a contingency plan. And there are some very critical things that you need to know. You have to know where your break evens are. Calculate them, write them down. You have to know what the return on risk is. So this is, I'm risking, the spread has a risk, there's a return. What is that ratio? Here's the other one, and this gets to the importance of portfolio management. And this is the next level. Once you understand strategies, getting to the point of managing a portfolio. I've got $100,000 portfolio, or $1 million, or a $10,000 portfolio. What position size should I have? How much capital do I need to set aside for my contingency? That's what a project manager does. And the project manager has plans for what if things go wrong. Schedules get busted, things don't get delivered. Same thing happens in your stocks. And you should plan on it. You know that it happens, and the time to figure it out is before. This is why you have to make your bed and do your due diligence every day. So for me, when I'm looking at, this goes back to setting up sort of 2 slides ago. I'm setting aside capital. As Greg mentioned, we're going to buy the stock, or we mentioned here, if the stock goes up in this trade, the Costanza trade, we buy the stock. You should be calculating how much money you're making on that stock capital. Now, you're not necessarily using it. And guess what? It could actually be in another account. It could be in another trade. Or to be efficient in your portfolio, maybe you have multiple trades pointing to that same capital. All concepts that are worth discussing. But I want to make 20% return on my capital. The secondary exit capital, and when I deploy that capital, I'm looking to make a 20% annualized return. So annualized return is the return on capital times 365 divided by the duration. And then you got to track your trades. So you got to know what your cost basis is. And now we're not talking about tax cost basis. We're talking about being like a landlord who owns a property and they collect rent and they have expenses, insurance and maintenance. At the end of the year, you want to know how much you collected, how much you spent. Same thing with tracking your trades. You have to keep track of that. And this is one of the things that we specialize here at Trader Oasis is we've got a fantastic tool we call Strategies. For people who trade like this, anybody wants the software, it's $10 a month. You get commission-free trading and you get access to some really powerful tools. And this strategy tracker tool that we have is very valuable and powerful. And I'm going to tell you, hands down, has made me a better trader. I can trade more trades with less stress, and my results have gotten significantly better. So we're trying to empower you with those tools. But you also know what you need to know what your risk is and your return is, and then keep track of the odds of you at least breaking even and making some sort of return. So let's get down into it. So I say hope for the best, plan for the worst. This trade works, this bear call works if the stock is bearish, if the stock is stagnant, even if it's moderately bullish. And if it is, the options could expire worthless. Now, I use a metric that I call the 50-50 rule to close a trade early. So if I can capture 50% of my profits or more in 50% or less of the expected duration, I will close the trade because I have exceeded my annualized return. Now you're going to take this, it's not a, I say it's a rule. Rules are meant to be broken. So this isn't a law. You don't have to do this. And for some trades, it doesn't make sense. But for a lot of trades, you can take that capital off, redeploy it, and maybe there's a better opportunity. If you think it's worthwhile staying in the trade to try and make more, great. But I'll often close a trade early and then just go deploy my capital someplace else and do another trade.
And let me throw one caveat out there that is going to talk about the benefit of Trader Oasis as well here, is that one of the things that makes this rule, because I agree with this concept of closing trades early to capture profit, because I can't count how many trades I've been in that the trade goes in my direction, I'm making money, and a week before my trade's supposed to expire and my options are going to expire worthless, the stock does a reversal and goes the other way, and all of a sudden my trade is back at risk again, and I may have to then make an adjustment or close the trade for a loss, all out of that I didn't want to pay a little bit of extra commissions, usually is the argument in the past. Now, the nice thing at Trader Oasis is it's commission-free trading. And so you roll in and out of that trade, it doesn't cost you anything more. And so again, here's another tool that's available for you to help you make better trading decisions. Too many times we make a bad decision and stay with a trade because you don't want to pay that $15 to close the trading commissions. But if there is no commission, you make the decision, all of a sudden you're a better trader.
Yeah, fantastic. Thanks, Greg. So yeah, the other thing I want to mention on credit spreads, and this is true for bull puts, bear calls, iron condors. I use the analogy of a toothpaste. So if you take a full tube of toothpaste and you squeeze it, you get a lot out really quick. If these trades work for you, you get a lot of profit really quick. But getting the rest of that toothpaste out of the tube takes a lot of work. So you might find a trade like this that you're going to be in 4 weeks. In a week, you've got half of your profit or more than half your profit. That means you're going to take 3 more weeks. And like Greg has said, you might be cheap or trying to get the net, I'm just trying to get this last, $1 or $2 out of this trade. And then find the stock moves. And now you're back into a situation where, geez, I wish I'd have closed the trade before. So having these rules or having some sort of objective goals will help you to close the trade. And this is one of the things that I need, because I'm very explicit on this trade. And there are very key points in time. And when the stock hits a certain price, I follow them like religion, like a law. These are rules, but you can have very explicit, and this really helps the emotion because I'm a very emotional person. So what if the worst happens? You meet somebody new, right? So this is what we hope happens, actually, is we want to buy the stock. You enter this position, you were considering buying the trade anyways, but you set up this bearish trade. If you buy the stock before the shares cross the short call strike, so it gets up to the short call strike, for me, when it hits that point to the penny, that's when you buy the trade. Now, if you buy the stock, when you do that, you will be in what we call an exploding covered call. So you've got long stock, which you just purchased, a short call, and a long call. So that's a covered call plus a long call. The short stock and the short call are the covered call, and then you've got this long call on top of it. What this means is you've got a high probability trade. So that when you do this adjustment, the trade will now probably be 55 or 60% chance of you at least breaking even if the stock drops back down. But you have no limit to the upside. And this is what a lot of people don't like about covered calls is you've got a limit to the upside. With this structure, if the stock continues to rocket higher, I've had people do this trade. Some of our students say these trades have been hands down their most profitable trades. So there's no limit and you're in a high probability of making money. Now, you could decide to purchase shares before the break even. If you do that, if it's at the break even, that's sort of a limit. At the break even, if you buy there, let me back up here. Yeah, if you buy at the break even, the trade won't make money. So what you need to do then is start focusing on this long call, because you've got a short call that's losing money if the stock is going up, but the long call is making money. So what you might be able to do is close the long call and get yourself into a decent profit, or potentially look at rolling or adjusting the long call into a bear call. So we're getting a little bit down into the weeds on this. And what do you do if it goes higher? We've only got so much time here, but so I'm just touching on this here. But what's much worse is if it goes, the very worst thing that happens is it goes very, very high. So the stock explodes through both of your strikes and it's way high. Here's an important point to note. You should still buy the stock. Not giving you trading advice. I would still buy the stock. At this point, when I buy the stock, if I sell the long call, the trade will have a P&L that is no more than the original risk of the trade. So remember back when we were talking about this ratio 1 to 2, 1 to 4, whatever that is, if let's say the risk was $400, when you buy the stock and close the long call at that time, you will absolutely not be down more than $400, whatever that max risk was on the original spread. This is why it's important to keep these relatively narrow, not very wide. And if you're only trying to make $400, depending on the price of the equity, now you're only looking at, if you do this on something like a Microsoft or an Apple, you're only looking at rolling a few months out on the short calls and you're back into a profitable trade. So that's normally what I do if the thing explodes to the upside. Now, if I thought the stock was going to if I was really, really bullish and I thought I was going to explode to the upside, this might not be the strategy. This is a trade that works if I think it's going to be a moderately sort of slow trend up that I would use. But even if it is explosive, there are some adjustments. So we're getting a little bit deeper probably in some of these adjustments. And then there's the next one, right? So what if I buy the stock? What if I do this adjustment? And then the worst thing happens is now it turns around and goes back down. And that is definitely beyond the scope of what we're going to talk about here. But Greg Jensen is the guy that introduced me to the collar trade. And there are quite literally, and there's not an iota of an exaggeration here, there are 100 ways to structure a collar trade. It is hands down the most versatile strategy that is out there. Can even get you in a situation where you cannot lose money. You can own shares and not lose money. You can make money with the stock going down. There's all sorts of different structures. And that's everything that I said here about this strategy is predicated on the fact that you understand how to manage a collar trade.
The collar, in my opinion, is the goal of all of my trading. Everything that I do funnels to a collar trade as my safety net. And you're absolutely right, Eric. There's multiple ways you can structure it based on your personality, based on the amount of capital you have, based on your age, your investment goals, how much time you want to spend managing trades. If you want to do like very little maintenance but yet still have some upside and limited risk, there's those types of collars. If you want to be a really active trader and have a much higher upside, there's those types of collar trades. And that's really what we go into in our education at Options Analyst, teaching you how to use this this path, so to speak. I mean, Eric showed an example of one trade that can ultimately lead you to a collar trade. That once you get it there and once you understand conceptually how to use a long call in combination with things, how to use a long put, how to use a short call, how to use a short put, and combine them in different ways, the sky's the limit, so to speak, on the different ways you can trade it, and all at the same time controlling risk. Because to me, that's what investing is all about. I know a lot of people categorize investing just as another form of gambling, legalized gambling in some states where gambling isn't legal. But it's not if you take the right approach. I can't go into Las Vegas. I can't walk into a casino and hedge my bet against the casino. That's when the tough guys come and get me and put me in a back room and break my fingers, right? If you're counting cards or if you're playing with loaded dice or whatever it might be, the casino doesn't let that happen. The stock market can't do that if you do the math and if you educate yourself on how to understand this process of risk management. So, yeah, I love this trade. It's
Do you think I should show an example of one that I just did recently?
Sure. Yeah.
Okay. So this is a real trade that I just placed here. So last week on the 8th, when Microsoft was trading down here around 372 or something like that, 374-ish, I placed this trade actually here on the 8th. And the strategy that I put on was the 377.50 and the 387.50. So I did that 2 strike wide. So I have or 3 strikes wide. There's a strike in the middle here if I need to make this adjustment, and $250 profit versus 750. So I've got that 3-to-1 ratio there. And what happened was immediately you can see that, well, not almost immediately, but 2 days later, the stock crossed right above that short call strike and above my break even. So what I did was I purchased the shares. So that put me into, now the stock was trading right here into a trade that if everything expires like it is, I'm going to lose $145. And this is a low probability trade. So ideally I would have purchased the stock before it got above this short call at 377.50, but it gapped up so quickly I couldn't. So I held on to this trade because if you see this, it's got this upside up here. There's no limit to the upside. I'm making an assumption that you folks know how to read these risk profiles. They're very, very helpful at being able to see where your profit and risk are. So I ended up closing that long call, which put me into a trade that brought me back to the exact same profit I was going to make before. Well, it's off by $5. So I closed that long call, but then I actually rolled it out a week and changed the strike a little bit. So now I'm in a trade that's got an 80%. This is real time. This is as of right now. I've got about an 80% chance of making any money. I've got a 70% chance of making 468. Now, the question you might ask is, what about the annualized return on this? And that this was initially the trade was going to make 21.7 annualized return on my capital. And now I'm in a trade that'll make about 25% annualized return. And so I'll capture those profits unless I can improve that picture better. So I plan to be out of this trade here on the 26th. And these are the sort of style trades that I do. You know, you're not buying lottery tickets here. You're not shooting for a home run every time. If you're just buying long calls and long puts, I would be happy to be on the other side of your trades. You're probably not going to make money. The market's not set up for you. But for those of you that take into account these things that we talked about here, you can be trading the same way. And at Options Animal and Trader Oasis, we try to give you the tools that you need, the education, the knowledge at Options Animal with examples and coaches that you can talk through to. And then at Trader Oasis, we give you the tools that you need to trade with excellent commission structure. And for those who want to go at some of the advanced stuff that we have, we provide a lot of trading ideas and daily ideas and examples and lots of webinars talking about markets. Well, that takes us to the end of time. How do we do here?
I think we did all right.
Okay.
I've got one of those trades going on right now too. However, it worked out the Costanza way in that, you know, I wanted to buy shares of Micron. And so instead of going and buying shares of Micron at 85, I did a bear call and Micron's pulling back. And my
See,
trade's going to work out just great.
So were you wrong or were you right?
I don't know. That's the question. I think I
Who
was
cares?
wrong.
You're making money.
I'm making money. It doesn't matter. It doesn't matter.
All right. Well, hopefully this was fun for you folks. Yeah, be careful. I do think you need education on this. This is going to give you some insight, but I don't expect anybody to come away being an expert. But if you stick with us, we can help you get there.
Thanks, everybody. We'll see y'all at the next one.